The S&P 500 is down 8%. Tesla is down 12%, and Battery Day was a disappointment. Nikola is a complete fraud, and the CEO and founder should be going to jail. And you're losing money selling options on the wheel strategy. They told you that the wheel strategy was win-win and you couldn't lose. You just sell a put and you get assigned, and then you sell a covered call after that and gets called away. But they didn't tell you what happens if those shares keep dropping in value. I know how that feels. I feel your pain. My shares are down too, and my calls are well out of the money and losing value. And to sell new calls, I'm going to have to drop my call strike price to lower than my cost basis. But how bad is it really? That's what we're going to talk about in this video. We're going to compare my options wheel strategy to the alternative of just buying the shares outright and see how much money I'm down. If you watch my other video about my plan to sell my calls that were assigned on last expiration, you see that you know that I had a plan to sell covered calls at a strike price higher than my cost basis. But since then, shares have fallen further, and now I cannot sell covered calls that are worth any money for above my strike price. That's what we're going to look at in this video. If you're new to the channel, I'm Justin, and I like to talk about dividend investing, income from options, and financial independence. So if you like these kind of videos, really appreciate if you like this video, subscribe to the channel if you haven't. All right, and we'll talk about my options, and we'll see how my wheel strategy is going right now with the little correction we're having in the stock market. The issue I'm having right now is I sold a put on a few companies, and then the put got assigned, but then I wanted to sell a covered call to near, my strike price or above my strike price, but I couldn't, and the shares keep going lower, so I had to drop my strike price for my covered calls to below my cost basis. And I'd really rather not sell my shares for below my cost basis, because then I lose money, even on a foolproof win-win strategy like the wheel. So let's go into my E-Trade account and look and see what is going on, okay? All right, here are my put and call positions. First one we will look at is CVS. This is a covered call now. So I have, let's see, what are we looking at? Okay, this is my covered call position total. We got assigned the shares, and the current share price of CVS is $56.71. And my cost basis for CVS, this is after selling the put and receiving premium. My cost basis is $61.47, so I'm losing a bit of money there. I sold this $60 strike price covered call, and I sold it for $119. So those are the two positions put together, or separate, but if you put them together, my cost basis after selling the covered call is $60.28. So that's well below my strike price. Next, we have my Kroger covered call. And so I had two contracts at Kroger. They were assigned. The current price of Kroger is $33.43. My cost basis for Kroger, $34.29. And where's it at? And then I sold a $34 strike price covered call. I sold that for $76.48. So my total cost basis for my covered call for Kroger altogether is $33.50. I sold Walgreens. That got assigned. My cost basis was $39.12. Current price of Walgreens is $35. I sold a $38 covered call on it, or a $38 strike price covered call for $79. And that means my cost basis for Walgreens right now, $38.33. So I'm still down, about $4 per share. And then XLE, the Spider Energy ETF, cost basis of just the ETF when it was assigned to be $35.26, currently trading at $30.20. And then I sold the covered call for 72 cents per share, $72, and that dropped my overall cost basis to $34.50. So all my covered calls are losing money right now. They're all negative. I have a GDX put. This is the gold miners ETF. The put is looking okay. What is it? $38 strike price. That's currently out of the money. These all expire in October. Intel put. That's well out of the money. $47.50 strike price and currently trading at $49.16, so that looks safe. I have an AT&T put. This is right at the money. $28 strike price, and AT&T is trading at $28.04. Then I have XOP. This is, what is this? This is another energy ETF. Having two energy ETFs probably, I could probably diversify out of that. I should probably get rid of that. One of them is like just the energy ETF, but the one's like an explorer and producer ETF. $46 strike price, well in the money, $42.90. So that's well in the money, and that will most likely be assigned to me come expiration. So if the current price of CVS is $56.77 and my cost basis is $60.28, I'm down 6% on CVS. Walgreens, current price $34.66, cost basis $38.33, I'm down 10%. Kroger, current price $32.82 and the cost basis is $33.53. That means I'm down 2%. And XLE, current price $30.11. Cost basis $34.54. I'm down 13%. So this looks bad. I mean, it's not great at all. Like, we'd much rather be making money than losing money. And I'm down a little bit on my covered call positions. And it'll take some time to reduce my cost basis to get back up to even. But let's go ahead. We'll do a little bit of math and see how this compares to the alternative of if I would have just bought these shares instead of selling a put on them in the very beginning. Okay? All right, let's do some math. Okay, that doesn't look too bad. So after I ran my calculations and can compare my loss now to what would have happened if I'd have just bought the shares, let's take a look at that. So I bought I sold all the calls about August 12th or so. August 12th and August 11th and August 21st. All about the same week. So that's not really too important. But we'll look at the price that they were trading at when I sold the original puts. CVS, the original put was, or the original, the stock price was selling at $65.54. So if I would have just bought shares into CVS, I'd be down 13.4% versus current price instead of being only down 6%. Walgreens was trading at $42.50 and I'd be down 18.4% instead of 10%. Kroger was $36.65 at the time I sold the put, and that means I'd be down 10.5% versus being down only 2% right now. And XLE was $39.11. I'd be down 23% on XLE versus being down only 13% right now. So there's a big difference with selling those puts and then the covered calls to reduce your cost basis. Even though I'm down a little bit of money, I haven't lost nearly as much as if I would have just bought these shares outright and held them until now. And I think CVS and Walgreens, they might have paid a little bit of dividend, so you just, maybe tack on a 1% to that. Still doesn't make a big difference. And what helps me keep my cost basis so low is that I'm selling monthly contracts. I'm not selling weekly contracts. If you sell weekly contracts, you can't reduce your cost basis. You can't reduce your strike price as far. And if you get assigned, then you're already dealing with share price and you don't have that extra flexibility in selecting your strike price. But I've rattled on about monthly and weekly options before. So hope you get something out of this. There's no need to panic if your shares are falling a little bit right now if you're selling the wheel strategy. But none of this is financial advice and none of that kind of stuff. This is just some thoughts on how my wheel strategy is going right now. If you like this video, go ahead and like the little thumb thing down there. I'd really appreciate that. If you like these kind of videos, I'd really appreciate if you subscribe to the channel. Leave a comment down below if you have anything to say. You can say hi or whatever you want to say. I'll put some more videos over here, and I'm putting out videos every Monday, Wednesday, and Friday, or Friday, maybe Saturday. So you can subscribe for those new videos, and then until I see you on Monday, there'll be videos over here that you can watch, and I hope you have a good day. All right?